Michael, great to have you with us. And I know you focus quite a bit overseas, and I want to get your reaction, first of all, on China. You know, this House vote coming through against China. How does that change your outlook, or does it at all?
Well, first of all, I think it's a very dangerous and slippery slope that the House has gone down. A trade war at this point is the last thing that this very tentative global recovery needs. But when we look at China, I think that the big question we've been asking is, can they engineer a soft landing? There was fear in the second quarter that China was due for a hard landing as they pulled back a lot of this loan expansion. I recently just got back from China, and I think our takeaway there is that they have done a very successful job of engineering a soft landing. Growth will slow in the second half from the first half, but that's a healthy slowdown, and we would expect growth to resume at around the 9% range into next year. So I think the scenario of a hard landing in China is unlikely, which is very encouraging for our global outlook. However, this focus on the currency and potential trade war is very troubling.
Well, that's what I mean, is that, you know, if a full-blown trade war breaks out between the U.S. and China, does that soft landing disappear?
I think it even goes beyond that. If there's a trade war between the U.S. and China, the global economic recovery is seriously at risk, not just China, but ours in particular.
Okay. Then I know that you've played the China story. At this point, then, do you want to be directly exposed to China in whatever way you can, or do you want to be sort of peripherally exposed by perhaps investing in other countries that have some trade relations with China?
Yeah, I mean, we've played most of our China exposure indirectly. So investments in places like Australia, Korea, which have very direct trade linkages. They are also the recipients of a lot of Chinese money that's flowing out of China and making investments in natural resources. So most of our exposure has actually been indirect through other countries.
Okay. Then in terms of your strategy, then, how are you playing it in bonds, particularly with the idea that perhaps this could all fall apart, you know, in the global economy? How do you play the bond markets then?
Well, first of all, I think is diversification. You know, we have investments in over 30 different countries, so you don't want exposure just to one idea alone. But what we're finding very attractive internationally is that you can buy short duration assets, so you're not taking a lot of interest rate risk, and earn 3%, 4%, 5% yields. Whereas in the U.S., you know, to even get a 2.5% yield, you have to go way out the yield curve. So the nice opportunity internationally is that as these countries have been growing, they don't face the deleveraging issues, they don't have the huge amounts of government debt that we in the U.S. are facing. You can actually get a decent yield in a currency that is undervalued without taking interest rate risk. Okay,
very interesting strategy then. Michael, thank you so much for joining us. Appreciate it. Michael Hasenstab, our Bloomberg Best in Class of Templeton Global Bond Fund.